Resurgent India Knowledge Series presents Virtual Session on Navigating the Landscape of Debt Capital Market. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers Mr. Ekagra Jain, Partner, Banking and Finance, Wadia Hande Co. Ms. Fatima Ali Akbar, Fixed Income Market Specialist, Bloomberg. Mr. Kishore Lodha, CFO, Ugro Capital. Mr. G. Subramanian, GM Treasury, SIDBI.
Yeah, good evening, friends. Friends, I'm Ashish Agrawal from Resurgent India. I would like to welcome to all of you, along with the panel speakers in this webinar, which is on very important topic in the current parlance. And today is very historical day for us, where the JP Morgan Index listing the Indian bond also in their index. So this is really a very great day for us. And this Indian bond market is where we are having a lot of participants in this market actually, and this market is growing also. In last 2-3 years, there are a lot of changes are there from the regulator point of view. If you see, it's a complete transformation is happening in the Indian bond market, or I'll say the fixed income market actually. If you see that last year we have, I think almost there was issuance of some 10 lakh crore, which is growing from I think almost 20% year-on-year basis actually. And if you see the overall bond market, Indian bond market is roughly something around 45 lakh to 50 lakh crore, which is in comparison to the equity market, it is very small actually. But the way the government is or the regulator is trying to ease out or ease of investing in the bond market, we believe that in next 7 to 8 years, it will be more than double in the overall Indian corporate bond market actually. So there is a good opportunity, or there is a good opportunity for the all the participants, all the players, those are there in the Indian corporate bond market, to invest and to get the advantage of the returns or higher returns on the bonds. But there are certain challenges are also there, which we will discuss. So we have very good panel today. We have Ms. Fatima from Bloomberg. She is covering the entire South Asia on the fixed income markets. Then we have Mr. Kishore Lodha, who is the CFO of Ugro Limited. He is expert in the NBFC bond market or NBFC funding. And then we have Mr. Subramaniam, who is the head of Treasury and GM on SIDBI. So he's from practically the DFI, and they are covering on MSME side. So we will listen his views also. Then we have Mr. Jain, Ekagra Jain, who is basically partner in the law firm and Wadia Gandhi, and he'll cover up on the regulation side on the growth of the market also. So friends, I would like to welcome you again in this webinar, and I would like to run a small PPT which might give you some idea where we are and where we want to reach. So I will request to my team to please run through the PPT. So we will discuss today on the current landscape of the Indian bond market and the inclusion of JP bond index, JP Morgan bond index, and then we'll discuss on the retail participation, because without retail participation, it is very difficult to get the growth in the whatever we are looking for. Then we will discuss on the green bonds also. We will discuss on the GIFT City also, where the new listings are happening in the green bond and other bonds also. So next slide. So friends, if you see the debt capital market at a glance, so there are some 5-6 instruments which are there in the Indian bond market. This is for the beginners and the basic for the industry. So bonds, commercial paper, securitization, debenture, treasury bills, and GSEC. And then if we see the market type, so private placements and the public issues. So there are two types of issues are coming, which one is from the private placement point of view and another from the public issue, which where the retail investor can also participate. So there are certain guidelines for both kind of issuances, which we will discuss in detail. Then you see that the debt market in India. So this money market is divided, and then the bond and corporate deposits, and then the government securities and the corporate and PSU bond markets. So we say market where different instruments are there, different maturities are there, and the different requirements are there. Next slide. So if we see the Indian corporate bond market, as I told that if you see in the slide on this graph, in last 4 or 5 years, this number has almost, I think, reached to something around from 6 lakh crore to 6.81 lakh crore to 10 lakh crore actually. And this year, 2024-25, we are hoping that it will grow from 20% plus. So every year the number is increasing. But the only thing is that we go through on the public issuances, this number is very, very small. So public issuances is only roughly around 2% of the overall corporate bond market issuances every year. This we need to discuss also. And out of this total 10 lakh crore of investment issuances, 73% is from the BFSI sector. So still the BFSI sector is leading the entire bond market in India. And out of this 73%, almost 25% is from the NBFC. So NBFC in the overall BFSI, they are taking almost 25% pie. So this is a good number also, and this number is growing year on year basis actually. And with the new guidelines where the RBI or SEBI has come out that the corporate should go for the diversification in their borrowing profile, so that this number will also increase in future actually. And if you see the CRISIL, as per the CRISIL report, they are hoping that this market will develop, will double very soon, the way it is growing. So next slide. So from the regulation point of view, the government or regulator has tried a lot to ease out or ease of investing point of view. So they have introduced the GID and KID guidelines for the private placement in the bond market. Then now the every issuer has to disclose the issue expenses. So this is a very transparent way of issuing the any so whatever the issue expenses are there, these should be disclosed in a transparent manner. So this is good actually. Any investor or subscriber will know in advance that what is the issue expenses on the overall issuances. And then this is a compulsory thing that now any company who is listed, who is having the listed investment listed issuances earlier from so now onward they have to have the only listed bonds in the market actually. So they cannot any company which is having listed bond in the market, they cannot issue any unlisted bond. So this is good that the listing will be there. Then a lot of I think transparency will be there also. And then the SEBI has basically this reduce the ISN number from 12 to 9. I think this is maybe because of that they wanted that larger issuance should be there instead of small issuances by any issuer. And then the electronic bidding framework basically, so they have brought the anchor investment concept where the anchor can be finalized like any IPO in the private, the share market, the anchor concept is there. Here the anchor concept has also come, so that there should be certainty to any of the anchor that they will get this much of the share in the entire issuances. So this is another new thing which has done in this market. And then we see this is a major, I think, area where the government has allowed these banks to basically keep this corporate bond for HTM. So earlier they were worried about the mark to market. Now they are not having this kind of worry. So they can invest and they can keep it for long term in their books actually without doing mark to market. So this is a big thing. Actually, we are interacting with the banks. They are planning to invest a good amount of money in the corporate bond because their P&L will not be impacted on quarterly or yearly basis because of this ruling. So this is a good thing. This will definitely add more and more investment in the corporate bond market from the banking system. And then we see that there are other these things are also there where the government has allowed. Yeah, next slide. From the retail investment point of view, retail investors point of view, if we see the number is not very big. If we see the chart, this in the last 4 5 years, this number is in growing, but practically it has not reached to a size where we can say that the more and more retail investors are coming and they are participating. Still, in the last year, it was 20,000 crore. And there were almost, I think, by the NBFC, there were 45 issuances. And if you see public issuances, out of that, if you see that major number of issuances were there from the AA rated companies. So this need to be discussed. I think government has tried or they are trying to do something better and better where they have allowed these OBP platforms to connect with the retail investors through the digital mode where the investment can be done at the click of button. So I am quite hopeful with this OBBP platforms already. I think 17-18 platforms are already there in the market. They are grabbing the investors and they are giving the opportunity to the retail investor to invest. Like SIP, the retail investors can invest here also in the bond market. So this is another, I think, advantage to the retail investors. Then the minimum investment size also is reduced. So I think from 10 lakh to 1 lakh now the proposal is for 10,000 also. So this will also help to invest to the investor who are small and they want to invest in the fixed income market in the small amount actually. So this will increase the number of investors, and I think this will help to get the more and more money for the issuer also. Yeah, next slide. So as I told that this inclusion of Indian bond in the JP Morgan index, this is a big thing for us. And today it's the day where they are including it in their index. So with this, I think we will discuss with our panel speakers, but we think that there will be the more and more investment in India in the government bonds, and there will be there is some expectation that there will be something around 20 to 25 billion investment will come in next maybe some years. And they have given the window of 10 months. I think in 10 months it can reach to that stage. So this is one good thing, and Bloomberg is also in the pipeline. So we have Ms. Fatma also she will speak on a personal behalf that what will be the additional investment which will come when the Bloomberg will also allow Indian government bond in their index also. And as per the announcements, I think this will happen in the month of January 2025. So roughly 6 months after from now actually. Yeah, next slide. So with this investment, I think we will discuss with our speakers, but this will bring, I think maybe the yields may come down and there'll be availability of more funds to the different different issuers also. So I think this will be a good thing for the entire fixed income market. Yeah, next slide. So when we are talking about the fixed income market or the bond market, I think we need to discuss on the green bond also, because climate is one of the major thrust area for all the financial institutions, all the corporates, the government also, the different government also. So India is also now growing. They are taking baby steps where I think some of the green bonds have already been issued. And you see that the government itself has also raised green bonds. So just to give you the basic knowledge that green bonds basically covers this 4 5 aspects. So one is the issuer, and the second aspect, which is very, very important, that is issue of proceeds. So whenever you are raising green bonds, the proceeds can be used only for the climate purpose or green purpose, whatever the purpose you have raised, these can be used only for that purpose. Then there are selection criteria for the green bonds. How you will select? What are the major criteria? Certification is another area because we have seen in some cases the greenwashing is there actually. So the certification agency or certification infrastructure system, it is very important. So now the government has come out with the ESG rating guidelines also, where some licenses have been issued. So the certification from 360 angle is very important, and this verification by the third party and reporting external review. So I think a green bond is a good thing, but I think there will be a lot of infrastructure which will be required to certify or to verify or to basically use of proceeds, also monitoring of it also. But this will be a good thing because we can contribute through a green bond to our climate funding or the climate side also. Yeah, next slide. So in green financing, these are the sectors which are covered, or these are the area, the segments are covered basically. So there are some 10, 12 segments are there. These are energy solutions, bioenergy solutions, which cover these all solar or hydro, wind, and all related energy solutions. Biofuel and biomass, which is also growing. Waste management and recycling. Water treatment, I think this will be a major area in the overall climate financing. Then EV, electric vehicle funding in that green bonds, it will cover also. And geothermal energy pollution. So there are the blue bonds and green bonds. So blue bonds are mainly for the aqua related activities. So if we see as of today, the government has raised two round of Indian government has raised two round of green bonds. So the first round was 16,000 crore, and second round was 20,000 crore in 2024. And this year we are hoping that there will be maybe 25 to 30,000 crore of green bond issuance by the government of India. And private sector is also taking baby steps where they have raised almost 6,000 crore of bond issuances in the last year. And this number will increase further because a lot of private corporates or the financial institutions are in the pipeline to raise green bonds in the market. Yeah, next slide. So GIFT City, because you know that the government has created this, set up this GIFT City in Gandhinagar. It is country within the country, and where the lot of tax advantages are there, and entire ecosystem has been created there, where the investors are there, the financial institutions are there. Then you see exchanges are there, depositories are there. So I think every stakeholder is already there in the GIFT City, where you can raise money from that GIFT City from the international investors also. So this is one thing I think GIFT City, and there are tax advantage are also there to the investors. The GIFT City has already come out with the GIFT City this green bond framework, where I think there is something 14 billion green bonds have already been raised out of 56 billion of the bonds which have been raised in the GIFT City, which is a big number actually, if you see. And then there is some estimate that there will be green financing by 2014-7, 47 up to 47 trillion. I think this is a mind-boggling number actually, which it looks very optimistic, but hopefully we will cover up that number actually. And if you see, there are companies which have already raised green bond, like Adani Green Energy or IRFC. This is a Indian Railway Finance Corporation. Then the other corporates are there. So both the private corporates and the government institutions are raising green bonds from the GIFT City. So this also we will discuss with our panel speakers, that how they see that that will help to the more funding in the Indian market, Indian corporates and the Indian government also. Yeah, next slide. Then if we see the NBFC, because NBFC is having the largest share in the overall kitty. So they told that this number is growing, NBFCs are growing, their lending is growing, and they are serving to the unserved actually, if you see. So there is a good synergy between banks and NBFCs, and they are also raising money from the debt market also. So we see that NBFCs have already raised good amount of money from the debentures from the debt market. So roughly 11,000 plus crore, 11 lakhs plus crores of the investment is already there in the debentures of NBFCs. And this number is growing also. So the way the number of NBFCs are growing and their lending is growing, we hope that there will be more and more issuances from the NBFC side also. So we have Mr. Lodha, he will, I think, give you a lot of insight about that actually. So friend, this is all from my side. Just I thought, let me just give you some background so that we can take up the discussion further. Now I would like to invite the panel speakers for their deliberation. And I am thankful to all the panel speakers for joining with us at the short notice and on the last day of the quarter actually, where all of them are busy in the finalization of their numbers or the other things. So thank you very much to all of you, all the panel speakers. We have Ms. Fatima with us. She is leading that practice of the fixed income market in South Asia from Bloomberg. So madam, first of all, I would like to welcome you and thank you for joining with us. And
Thank you for
Fatma,
having me.
yeah, so I think today is a historical day for us. So we like to start from you, lady first. That how do you think? What do you think in this current scenario? And today, I think maybe after 1 hour, we'll know the progress also. So this inclusion of this JP bond index, the JP Morgan Stand bond index on the Indian bond market, Indian bond government bonds. So what is your view on that? I think we can listen from you. That will be helpful to all of us. So over to you, and thank you very much.
Thank you, Mr. Ashish. Thank you for having me. I know it's a very historic day when we are actually doing this discussion on starting with the discussion on index inclusion. I mean, it was almost a decade when from which there were talks about India being included in the global indices. I remember earlier when Mr. Raghuram Rajan was the governor. From that point in time, that discussion was there in the market that eventually India will be part of the global indices. And over the years, there had been many years when we were very close to getting into the indices, but eventually, finally, in 2023, JP Morgan announced that they will include India in the emerging market index. 3 months after, Bloomberg also announced that we are including them in the emerging market index. Now, why is that such a historic moment for us? Is till now we all know that we have been very strongly domestically funded. India being on this growth path over the years, our borrowing needs have been increasing. Government's focus on infrastructure has also required a lot of funding requirement or debt requirement that has been coming up. As of now, till date, it was always the domestic institutional players who were taking the entire burden of funding this particular requirement. Now, what we are actually looking at expanding that, in the base itself would be investing or funding this borrowing programs of the government and of the corporates in India as well. So to begin with, of course, the JP Morgan index includes the FAR bonds, FAR GSEC bonds, which are 27 securities that are included as part of the index. However, when we talk about that FAR bonds, okay, and the JP Morgan flow itself, it's the passive flow itself is almost 20-25 billion, because when we look at the JP Morgan index, looking at its overall assets under management, 10% is the weightage for India. That itself makes it like 25 to 30 billion in the next 1 year, which is a given. But apart from that, what it also adds on to, a lot of other investors who are not directly having JP Morgan as a benchmark index also have started looking at India as an investment destination. Of course, there have been, I think so certain things that have also been in favor with us is Russia had post sanctions, was out of the index. So there was a gap that had to be filled in. Investors were looking at other alternative economies where they find that stability and that higher returns or higher yields that can add to their portfolio. China got added in 2022. However, we all know that currently even China is going through certain difficult phases. Investors are a little wary. People are uncertain whether how much more do they want to increase their exposure to those countries. At such a time, India actually becomes a very important destination for them to look, because we have political stability. Our growth numbers are fantastic. We are the fastest growing economy in the APAC region. Our central government bank has done a great job in maintaining stability in the financial markets. So either we look at interest rates, we look at currency. It's a very stable market. Our forex reserves are very high. So it gives a very good opportunity for all these offshore investors to take a position on India. 20-25 billion is something that we are expecting directly as a passive flow, which is like directly the index flow. But apart from that, over time we expect a lot more, maybe around another 10 to 15 billion in the next 2 years, which will be part of all the other investments which are non-index flows also, which will come in. And that might be with FAR bonds, as well as it could percolate to corporate bonds as well. Okay. Currently, like I was just going through some data the other day, and I see that a lot of other emerging markets, which might be smaller than our Indian economy, still have more than 15% foreign investments in their debt market. Currently, India has just almost 2% or 2.5% of foreign investment in our debt market. Ours is almost globally, I think so it's among the top 5 in terms of size when we talk about the debt market, but the foreign investment is just 2.5 to 3%. Imagine now when we are now in this global indices, and going forward when this becomes a success, even if say the JP Morgan or the Bloomberg Global Aggregate Index, which is a much bigger index, if we get a chance to get into those indices as well, this flow will increase exponentially. So this 2.5 to 3%, maybe in another 2 years might go to around 5%. Eventually it might go to much higher, and the rise could be exponential as well. Now, how does that help us? Like as India, it definitely helps us. Why? Because the yields, the cost of borrowing which the government has on these yields will automatically come down when there are so much of foreign inflows coming in. Earlier, there used to be a lot of concern when there are foreign inflows coming in, there can be outflows due to which, currency depreciation is a risk. However, we have seen in the last couple of years, our central bank has been doing a great job in maintaining the volatility of the currency markets. And we are today like almost at the highest forex reserves as well, like 650 billion of forex flows. So that gives us a lot of comfort in terms of managing the currency risk as well, which I think so gives more confidence to these investors to put money into India, and for a longer term as well. So I think so. Just want to mention that this being a historic day, yes, but now this historic day will actually, over the years, we'll actually see the fruits of this particular historic decision that has been made. And we are all looking forward to it.
So much, Fatima ji. I think you have very well covered, and a lot of optimism is there actually in your discussion, and that is helpful also. So I think all positives which you have given. Is there any negative or demerit is also there in your mind?
So demerit as in what we have always seen, that currently also if you look, our market has more than 23,000 bonds if we include government and corporate bond together. However, these indices, the global indices, have just included those 25 to 27 bonds. Why? Because our regulators are still a little reluctant to open the market for foreign investors. They don't want that. There are limits on government bonds, corporate bonds, SDLs, in terms of how much quantum these foreign investors can invest. So apart from these FAR bonds, that is why you'll see that the maximum flow is just coming in FAR bonds. But we need to expand that to the other, universe of bonds as well, to deepen the market. That will be one thing which maybe would be looked into future. Second is, of course, the biggest risk has always been that, okay, right now these funds are coming. These are a lot of hot money, okay, especially right now. In the last 6 months, if you see, the yields have come down 20 basis. Of course, it's not only because of index, but it has played a major role. Now, you will also see a lot of front running is happening in these particular, because people were expecting that this flow is going to come. So a lot of front running was happening. So you would have, that's a very common thing which has been discussed, that even from GIFT City, a lot of foreign investors who are not even registered in India are coming through the route of ODI or offshore derivative instruments to just, get the returns that this particular market is going to give. Now, these funds over time will automatically move back, because they are just, short-term funds, or, they might just be playing on the current yield movement, which is expected to bring down yields by 20-25 basis. So they are just playing for that. They are not the long-term investors. However, with that as well, the liquidity in these markets increases. So that will help us. However, that will always be a risk that this hot money will always move out as and when, there are other opportunities. So that would be the only risk. But I am personally very positive that the way government has been managing the entire market, or the central bank has been, focusing on managing the currency positions as well, it will be a win-win for us in the long term.
Okay. Okay, there are two more things which you would like to just clarify from you because you are expert in that. Our NRI, they are also investing in the Indian bond market, but they have little exposure. So with this development, will there be any advantage to them, or there will be more inflow? And the other thing is also that we are talking, because some people are asking, this is only for the government bonds only, this index inclusion, or there will be corporates can also get the listing there also. So if you can clarify on this.
Yes, so definitely. So first, to answer your second question, currently it's only the government securities, and out of that government securities also only FAR bonds. FAR bonds is the fully accessible route, which was launched by RBI, wherein there is no limit on how much a foreign investor can invest. So as of now, there are 38 bonds under the fully accessible route, out of which in the JP Morgan index there are only 27 bonds which have got placed based on the criteria that they are finalized. So as of now, this index is including only these 27 bonds, and majority flow is coming into these 27 bonds. For all the other bonds, apart from these FAR bonds, there are limits by the regulator itself in terms of how much quantum foreign investors can invest. So say, for example, for other government bonds as well, it's only 6% of the outstanding amount that foreign investors can invest. When we talk about corporate bonds, only 15% of the outstanding amount is what the foreign investors can invest. Out of that limit of what 15% we have, again from that only 15% has been utilized till now. So there is even in the existing limits, it's marginally utilized, I would say. There is a lot much scope that the foreign investors can invest in those. But as of now, in index, when we are talking about, be it any index provider, this is a very important criteria that they want that particular bonds which they include in the index have free access. And due to the regulations, as of now, it's only the FAR bonds, which include those 27 government securities, which are getting included in the index. However, apart from these index players, there are a lot of other players who can still invest in the corporate bonds of India as well, with the limit of 15% of the total outstanding, which is still very unutilized limit. So I think so going forward, we'll see a lot of flows coming into even at least a lot of AAA papers, at least maybe not down the rating chain, but at least in the AAA papers, that could be flows coming in, not due to the index, but any increased demand overall for India bonds across the globe. So that could happen, but index will not, as of now, include only government securities, be it the JP Morgan, be it the Bloomberg index. It doesn't include corporate bonds. Yeah.
And from NRI point of view, what are your views?
Yes, so NRI investments also actually, I mean, we all know that remittances in India have always been very high in equity markets. Okay, so like 1994, we were the first listed. We were included in the global indices for equity, and over the years, we have always seen a lot of equity investments flowing from NRIs as well as foreign investors. We expect a similar flow from NRIs as well going forward. There will be a lot of increase. To be honest, right now, it's very difficult in terms of NRIs to say that how much will be the quantum or how much will be the increase. That number is something that I don't think so anybody can predict right now. Going forward, we will see a lot of increase. But looking at the returns that India provides them in terms of even in JP Morgan, we are the highest yield provider as compared to all the countries. So definitely NRI flows will also flow. But there, I think it will be more of whether is it moving to equity or debt. So that will be the juggle that will be coming in more when we talk about NRIs.
Okay, great. Thank you very much. So I think as per you, the inflow will increase and the yields will come down actually. So this is the two key things are there, I think, which will help to the Indian bond market. Thank you very much for your deliberation. So friends, now we have Mr. Kishore Lodha. Kishore Lodha, who is the CFO of Egro Capital, known face. So Kishore ji, first of all, I would like to welcome you in this webinar. Kishore ji, being you are the champion in the NBFC space, and you see the retail participation, which is very, very important. The government has come out with the OBBB platform also. So we'd like to understand your views on that, how this can be penetrated, and what are the challenges in that journey of the OBBB platform. And the another thing is that how the NBFCs are basically go to the debt market and the bond market actually, which are A-rated or maybe double A-rated and triple B-rated, because it's still, but we have seen the Indian bond market is not accepting much of the A-rated and triple B-rated papers. So if you can cover up on these two things, will be great. So over to you, Kishorji.
Thank you, Ashish ji. So as far as Indian bond market for NBFCs are concerned, we are seeing certain headwinds for some time, especially after 2017-18, when DHFL incident happened. One notable change that has happened that mutual funds have slowed down considerably on NBFC papers, especially on NCD side. There are two things which has come into play. One is the inflow in mutual fund debt market itself is very low, barring the liquid funds and overnight funds. The mutual fund itself, the debt funds are itself not getting any liquidity because the capital market is doing exceedingly well and the money is moving from debt to equity. So mutual funds don't have too much of liquidity in terms of debt schemes as of now. But moreover, the bigger change that has happened since then, DHFL has happened. Most of them have stopped doing NBFC lending in terms of subscribing to their NCDs. And mostly whatever little they are doing, they are doing mostly in AA and AAA rated papers. And that too in a very smaller quantum. So that has changed. But overall, if you look at the market in the last 2-3 years, the bigger changes have happened. Some of through SEBI intervention, some of through market intervention, and some of through the general growth of the country and the way we are presenting ourselves. So one important change which you have, as you suggested, is that OBPP platform. So now these are the earlier there were no structured platform available where the small investor can go and trade their bonds freely. Now there are regulated entities which are available who can help in trading these bonds. However, there are challenges around it, though SEBI has structurally allowed this platform to sell bonds with a denomination of 10,000 rupees. But as of now, the rules are yet to be announced. So as of now, the minimum ticket size is 1 lakh rupees, which is 1 lakh rupees ticket size is typically not for retail investors. You can say that it is for HNIs or ultra HNIs. Investor who would look at 1 lakh and onward. So retail investor participation will only happen when the ticket size would lower. However, it is creating a transparent marketplace for trading of bonds where one can invest with all sort of transparency and also can redeem when they need it. Though the market is shallow, market is still it is to some extent it is first bilateral deals and then pushing the deals into the retail market. This is what is happening. It is not a free flowing market as of now, but gradually once the maturity comes in, it is likely that these platforms will provide the free flow like an equity sale. But we are far off from that kind of scenario. Probably may take 4-5 years before we reach a stage where you can freely sell your investment in your bonds in a few minutes time. Probably we are still far off from them. But structurally, what I believe, where as a institution or as a setup, we are not doing enough is to assure the bondholders that about the security, about the yields, and about the transparency in the issuances. So if you look at the overall market, defaults in NBFC space has been very few, even minuscule compared to whatever overall issuances that has happened over the decades. But still retail investors do not get the confidence. They feel that if they do an FD with a bank, at least 5 lakh rupees is assured by the government of India where there is insurance. But if they do an NCD, though they may get 100-150 basis point more, but there are no regulatory support available. So where I have always been supportive of this idea, when I've been talking to this idea for some years now, however, there have been few takers around it, that the SEBI and RBI needs to put together their heads together and come up with a regulation where they charge a small fees on every issuance. And so you would take 5 basis point as for every issuances every year as investor protection amount and create a kitty in SEBI. So like when Karvi failed, every investor got their money back through SEBI, where there is from the protection fund. Now, if no investor would mind, like if we as an issuer, we pay 3 to 5 basis point to rating agencies to get our issuances rated. So we would not mind paying 5 basis point to investor protection fund, where it would create an confidence in a retail investor that my money is protected to a certain extent. So if a retail investor get a confidence that SEBI would protect them in case the investment is up to 2 lakh rupees or 5 lakh rupees, whatever is confident, whatever the SEBI feel right, then it would create a large market where a lot of investors, a lot of money would flow in, which will help. And 5 basis point may look high at this point of time, but imagine the yield that will drop down if the investor gets an assurance that their money would be protected by a regulator. So this has been a big change which I have been advocating for a decade, but unfortunately there has been no takers for it. Someday somebody would listen. I will continue to advocate it. Second thing, what I believe is that SEBI has been far more focused towards equity market, and they have not actively done much, barring few things which on the NCD side. So what I believe is that some of the restrictions which are there, which are creating more of a regulation rather than governance. So if you have to issue a public issue of NCD, the process is so elaborate and lengthy that it is almost like an equity issuances. But how does it help the retail investor? Does the bulky paper that you file, the hundreds of certificates that you get procure from chartered accountant that you file with the system, does it help in terms of protection of these gullible investors? The answer is clearly no. So SEBI needs to do more to make these processes simpler and seamless and less expensive, so that people can get the issuer can get the confidence of getting into the market with a lesser cost impact, and then market size expand. So these are the things which SEBI needs to put some more focus and which can help the market. Also, as you mentioned that SEBI has put in private placement 9 ISIN restriction. Now, if public market is so difficult to access in terms of issuing a public bond, and if there are restrictions on 9 ISIN maturity on certain years, then it restricts the market further. So if there is a private deal, it is a bilateral deal where the investor is taking an informed decision either to invest or not to invest. So the restricting the number of investors and restricting number of ISIN is not helping anybody's cause. I strongly believe that SEBI should open it up, increase the number of ISINs, increase the number of investors in private placement significantly, which will again broaden the market. So this is on the market side. What I believe is that a lot of money is waiting on the wings, where many issuers, especially the NBFC, have failed to target where the money is available. So like as you mentioned that there are global impact funds, there are domestic impact funds who are willing to put in money either for various purposes. Like last year, we have done specialized in NCD issuances towards the green energy, where the money which we have created out of that bonds are issued towards the green energy segment. Similarly, we have issued specialized bond towards WASH, which is water and sanitation segment. There are specialized institutions who has the money and who are willing to put in money for these segments. Women empowerment. We are just about to issue a bond where the entire proceeds will be issued towards women entrepreneurs, where the funding will go towards women entrepreneurs. Backward districts, where the development India has identified developmental districts where a lot of people are willing to put in money, where the money can go and help those districts. So these are various avenues which are available. many people have not tried to tap these markets, and the opportunities are very, very large. And I strongly believe that NBFC should look at these opportunities seriously, and huge amount of money is waiting in the wings, and we can tap this market.
Thank you, Mr. Loda. I think your views are very, very important, and you are advocating for the investor protection fund for the NCDs. I think this is a great move. Actually, if it can be done, a lot of confidence will be built up. And from the investor protection fund, there can be awareness programs also, because I think many people are not aware that investment can be done through OBBP platform at a click of button. So that's a good thing. And then you are given the idea of some new avenues for the raising money in the impact side from for NBFCs. So this will be helpful to our audience, because many NBFC treasury people or founders are there who are listening it actually. So thank you very much for your views on the NCD market, mainly specifically for NBFC point of view. Thank you, sir. So friends, now we have a very important person with us, Mr. G. Subramaniam, who is the GM Treasury of SIDBI. He is in SIDBI for many years, last many years actually. And SIDBI is a DFI, so Indian DFI, where they are supporting MSMEs directly or indirectly in many ways. And they have done wonderful job where they are lending money to the banks also, to NBFCs also, directly to the NBFCs also. So, sir, first of all, I would like to welcome you in this webinar. And sir, we would like to understand from you two major things, but definitely you can cover up more things also. One is that green financing, because I think in any country when the ESG or the climate funding started, it started from the DFIs only. So what are your views on the green financing in the Indian market, and how the SIDBI is geared up for the raising green financing through the bond market? And the second is the whatever the MSMEs bond market for MSMEs, because we have not seen such kind of evolution in the country. So if you can cover up these things, and then you can also cover up from the SIDBI point of view on the Indian bond market actually. Yeah, over to you. And your views are also important for the inclusion of this Indian government bonds in the JP Morgan index actually. So please, over to you, sir.
Thank you, Ashish. I'll just cover what. First question I will take that. What is about the green financing? How does MSMEs act to it, and what is the response from SIDBI side or from any DFI side? See, actually, if you see SIDBI from 1992 onwards, we have some specialized lines of credit which we have availed from various multilateral agencies, like for example, World Bank, JICA, KfW, ADB, and all. All these lines of credits are meant only for some specific purpose. What is that specific purpose? It is for like energy efficiency, climate change, green financing, for that purposes only. So when I take any line of credit from these multilateral agencies, obviously it is all these lines of credits are guaranteed by Government of India on behalf of SIDBI, and that is why these lines of credit are at a cheaper cost for SIDBI, and I am able to pass on that cost-effective credit to my MSMEs. I can do it through direct lending way, or I can do it through indirect lending way. Indirect lending way means I can give it to banks, and banks give it to MSMEs, or I can give it to NBFCs. NBFCs can give it to MSMEs, but the ultimate beneficiary should be MSMEs only, as far as the loan is available from SIDBI. That is number one. So all these foreign currency lines of credit which we are taking from 1992 onwards are for specific purpose, like only for energy efficiency. So far we had somewhere around 9,000 crore of foreign currency lines of credit, which we had on lended to NBFCs, banks, and direct lending to MSMEs. So going by the experience which we have gained over the past for so many years, we had set up a green financing vertical in Delhi, which takes care of only the green financing requirement of the MSMEs. Like the vertical is meant only for taking care of the MSME's green financing requirement. That is, if they want to put any plant and machinery, or if they want to do any wind power, solar power, or any climate change, anything related to green financing or for energy efficiency, they can approach this green financing vertical and they will be able to get at a cheaper credit vis-a-vis the other banks or other institutions in the industry. That is the major thing which we have created only for MSMEs, and that facility is available obviously only for MSMEs because we are created only for MSMEs. That is the one thing. That is the green financing. As far as the green financing is a concern, we have so many schemes under the green financing also. We are extending assistance based on repo rate as well as the fixed rate of interest. Whomsoever is interested in whichever way of a credit, they can avail it. So green financing as far as concerned, now also we are in the discussions with the various multilateral agencies like World Bank and KfW, ADB and all for sourcing further lines of credit. Last year alone, I think the industry has also gained a lot of experience and the trust being governed by the government of India. Last year, SIDBI could disburse around 6,000 crore alone in a single year for exclusively for energy efficiency and the green financing only. This is a substantial quantum which if SIDBI can give it to a direct lending to MSMEs to the extent of 6,000 crore. What I would like to say, that much of market is available, and only I am talking about only MSMEs. Other corporates must be doing 3 times or 4 times more than this MSME segment. So that much of opportunity is available, and people are getting awareness about the energy efficiency and green financing, which is going in a longer way for them to avail cheaper credit. Suppose, for example, any MSME goes to a market for availing a green credit, either it is by way of, for example, they float a green bond. In India, per se, there is no price difference between a normal bond or a green bond. That is the major disadvantage for any entity if they are floating a green bond. And the second thing is that there is no tax implication or tax benefit also if you float here, if I am an investor in the green bond. So because of these disadvantages, when corporates or institutions are not able to get the price advantage while floating a green bond vis-a-vis a normal bond, obviously MSMEs being the smaller segment of the industry, they will not have that advantage. They will be taken for a ride. So their cost of credit obviously will go up. That is the main disadvantage MSMEs are having while floating any kind of bond in the market, because obviously one is rating matters. They may not be having even a AA plus rating. So if they are rated less than AA, obviously the cost of credit will go up, and the subscription to the bonds also may not be to the fullest extent vis-a-vis the other institutions. Like that, if they can get credit from other institutions like a SIDBI or any other banks at a cheaper credit, it would go a longer way for them in their journey of a growing path. That is the one thing. Second thing, you asked about the capital debt market for the MSME segment. See, MSMEs per se in India are not that much handholded properly. So many of these MSMEs are still in the lower end of the segment, like your partnership funds or the proprietorship funds. Only very few MSMEs have gone into the private limited. Now, after this establishment of a SME exchange in both BSE and NSE, many MSMEs are coming forward in the capital market also to get their shares listed. Now, slowly that growth is happening, but majority of the MSMEs are still in that partnership segment or in the private limited companies. So, a lot of handholding support is required for them. And more of your what you can say capacity building support is also required to make them awareness about the bond market or its advantages as well as the disadvantages. This would go a long way to develop the market also for them, number one. And if like you have a capital market, you have a SME exchange in both BSE and NSE. If you can have a separate exchange in the bond market also, it would go a long way for these MSMEs to launch their bonds. See, once, for example, now there is a Treds platform available for discounting of invoices. So this once when it was started, SIDBI was also one of the promoter of the Treds platform called RXIL. When it was started, not much of volume was happening. But today, if you see, there are 4 such platforms are available for discounting of bills. So many banks are also participating, financial institutions are also participating in the TReDS platform, and the ultimate beneficiary is your MSMEs or any other corporates which are able to discount the bills at a very competitive rate of interest, because one bank will put a one rate, X bank will put that rate -1. So ultimate beneficiaries, they are getting the advantage. Like that, if you have a separate SME bond platform, then more number of MSMEs also will come into that platform, try to float their bond. They can do the price discovery also, like EBP platform, which is available for other institutions. If we can have a separate platform, that would go a longer way. Third is, now that the banks that RBI has reduced that HTM limit, there is no HTM limit available. So banks are also will be enthused to participate in such a kind of bond issuances. If RBI and the SEBI can give a relief that, see, when you put it in PSLC certificate, banks are getting the advantage of a PSL shortfall ka jo bhi gap hai. So if a bank or an institution puts money or invests money in MSME ka bond mein, if some exemption can be given or it can be reckoned for that PSL calculation, it would go a long way for development of this bond market for MSMEs also.
Great,
Yeah.
sir. I think you have very well covered and very well said also. But because you are head of treasury in SIDBI, we like to understand the impact of this JP Morgan index on the borrowing side or on the yield side, availability of funds. So what do you see in future actually, because you are raising a lot of money from the bond market? So if you can
Yes.
cover up.
Yeah, as Ms. Fatima has said that yes, this would give you a lot of boost to the GSEC market also. Obviously, everybody is expecting that the yields will come down. 10-year yield will at least come down to 10 to 15 basis points over a period of time. But the most important thing, I think she also has covered, that we should see how the stabilization of the rupee is going to happen. So because a lot of inflows are going to come at the same time, how the rupee is going to perform, which may have an impact on the exporters also. So what RBI is going to do, or what steps RBI is going to take for remove, as such they are removing the excess liquidity by VRRR, and whenever there is a liquidity crunch is there, they are doing a VRR and all. When there is no excess liquidity by way of these bonds also, and in order to stabilize the rupee and in order to have a control on the rupee movement as well as the inflation part, what RBI is going to take steps, that is wait and watch. Obviously, yes, I also agree that the yields will come down in the GSEC, which will have an impact on the corporate bond market also.
Okay, so it will be beneficial to the GSEC also and the corporate bond both actually.
Yes,
okay.
Obviously.
Okay, got it. So great, sir. Thank you so much for your views on the about Indian bond market and SIDBI views also. So friends, now we have Mr. Ekagra Jain, who is the partner in the Badia Gandhi, which is a national law firm having Pan India presence also. So first of all, welcome to you, Mr. Jain.
Thank you,
This, you are the youngest young participant or speaker, the overall this thing, all panel speakers. So without lawyers, I think nothing can be completed. So definitely your views are very, very important for all of us. And this is a financial market which we are discussing. So I think we would like to know more from you from the regulation point of view. I think because all our speakers have covered the different part of the bond market. So this government has come out with the EBP platform with a GID, KID, these kind of terms are there. Then the other regulations are there, which are the recent regulations. So what are your views on these regulations, and why do you think that whatever the Indian bond market is there, and you see that still the penetration is very, very less. So the like equity market, how it can be penetrated, with what kind of regulations would be there which can help to get the more penetration in the market and more participation in the market from the all kind of investors. So over to you, and thank you very much, sir.
Thank you, sir. So, I mean, the question we'll break it down into two parts. One is how the regulatory norms exist as on date, and then maybe move on to how we could overcome, or what are the solutions which could be addressed to specifically for those challenges. Now, SEBI has introduced various norms for listed bonds if an entity intends to do on a private placement basis or on a public issuance basis. Most of these SEBI norms are kind of a bit onerous for Indian entities. These include, GID, KID norms. There is EBP, which is a price discovery norms. Now, market view is that EBP should not apply for a private placement issuance because there's no price discovery for a private placement. Technically, it is just we are doing this to comply with SEBI norms. Now, the intention of the regulator, I think, while addressing or framing these regulations is to make it more akin to a public issuance, to enhance retail participation. They want retail investors to have full details of the Indian issuers, which is why detailed disclosures have now been built in. I think Mr. Kishore also put in a suggestion that we should have some form of fund being there, being saved specifically if there was something to default. So the retail investors could enjoy some comfort. So SEBI has introduced something called as a recovery expense fund. Right now, the amount is very low. It's set at 0.01%. But going forward, the number could increase so as to ensure that retail participants have a more comfort on it. From a SEBI aspect, I think the compliances are more to align it with public issuances. They have even imposed a lot of statutory auditor certificates to be now issued, even if the company wants to do a listed entity. These include statutory auditor certificates, even complying or confirming on the security cover ratio which the company is meeting. These even cover financial covenants that the company is meeting. So these are measures that SEBI is intending more to enhance retail participation, to get retail participants being more comfortable with the performance of the company. These are all independent factors that they want to bring in addition to the rating as well as the financial performance of the company. So that is how SEBI's idea has been as of now. For NBFCs or for companies for that matter, now SEBI has introduced from 1st of January that either you do listed issuances or you do straight away be on unlisted issuances. So for Indian corporates, there is a call that they need to take whether they want to do listed issuances going forward or whether they don't want to do unlisted issuances. Whether they want to continue only with unlisted issuances. Though one reason why you wouldn't want to do a listed issuances is because of the compliances under the LODR regulations which get imposed. There are various committees. Smaller companies with lesser compliance teams cannot comply with the listing regulations which are there by SEBI as on date. So for them to be able to comply with them, the SEBI regulations need to be a little relaxed as of now. I think a lot of suggestions have already been placed to SEBI. Now, SEBI, as a matter of fact, is very active on the corporate bond market. We see various notifications, consultations, papers being issued on I will say at least on a 2-weekly basis, if not a weekly basis. We are seeing various amendments. There are a lot of consultation papers being floated. So SEBI SEBI has been interacting with various market participants as well to see if there are ways that we could address it. So there are a lot of suggestions that we as law firms have also suggested to SEBI, saying that, there are certain compliances which could be relaxed upon by companies. These are not material in nature, but at the end of the day, we rely on how the regulator words the regulations. As of now, there are compliances which these corporates need to do. Their rationale from SEBI's end is that they want to make it much more detailed and much more nuanced for the retail investors particularly. So that is where they are coming out from. From a corporate bond future perspective, given that now SEBI has mandated issuers to do listed issuances if they have a listed exposure, we see a lot of now enhanced participation more for listed NCDs going forward. This should enhance more retail participation. So the future looks brighter for a corporate debt market going forward.
Okay, great. I think it's a good perspective which you are giving. So one more thing, I think GIFT City, which we try to touch upon in my PPT also. So do you think that this will increase the inflow of the money in the Indian bond market from GIFT City, and what are the challenges which people are facing there actually?
So GIFT City presently, the concept of GIFT City is it's a financial special economic zone that's been set up by the government of India. It's intended to be similar to how we have it in Singapore as well as Luxembourg. Entities that set up companies in GIFT City are firstly tax exempted. They have no stamp duties to pay. There are less taxation incentives which have been provided. NBFCs right now, we've advised personally at least 10 NBFCs who've raised funds out of GIFT City. The benefit to do GIFT City vis-a-vis a normal market is the taxation benefit which is available. A lot of companies raise funds from foreign impact funds who are inclined to invest for socio-economic purposes, for gender purposes, for water and sanitation purposes. Now, the withholding taxation in India is fairly high if these investors wanted to invest directly in bonds of Indian corporates. Whereas in GIFT City, there's an exemption being provided. So the withholding taxation is fairly low compared to if they were raising funds to the domestic market or the international market directly in India. So to that extent, GIFT City firstly provides a taxation benefit directly for the foreign investors to move their funds through GIFT City into India. The other thing which is associated with GIFT City is GIFT City comes with a lot of compliance benefits. We have a unified regulator in GIFT City called the IFSCA, which is the International Financial Services Center Authority. The IFSCA has the powers of SEBI, RBI, IRDAI, all consolidated into one entity. So you have one regulator to deal with if you were doing a transaction in GIFT City. Whereas if you were doing in India, you have SEBI, you have RBI, you have various other regulators that you need to deal with. So from a compliance perspective, GIFT City has a unified regulator, as well as the regulations right now, which are worded in IFSC, they are much more worded in a manner that could promote transactions. They are much more issuer friendly, as well as they take care of the investors. The regulator is also fairly reachable. There are various consultations which happen on a regular recourse towards an IFSC market. So we see IFSC going in much more larger phases going forward. I mean, from an IFSC perspective, it is the present central government's more objective was to have GIFT City as a special economic zone to be going forward, being set up. So to that extent, now that we have political stability in India, we expect that to flourish more.
Okay. Oh, that's great. So as you rightly told, the unified regulator. So still when we are talking to the corporates and NBFC, they are saying that they have to go to RBI and SEBI also for the GIFT City fundraising. So is it correct or?
So GIFT City has their own set of regulations which even permit an Indian company to raise debt. You do not require physical presence in GIFT City particularly. But if you're raising debt from a foreign investor, there are still RBI norms or SEBI norms which may apply. For example, you may have your FPI regulations, you may have your ECB norms which will still apply. Now, GIFT City only permits foreign currency transactions to be undertaken there. So if an Indian corporate wanted to raise debt, they still have to comply with ECB norms as well as comply with the IFSC norms. So to that much level, there is some level of Indian laws that are still applicable. You don't have to comply with the SEBI listing norms because SEBI norms don't apply in IFSC, but there may be some provisions of RBI that may hit upon you if you were doing a transaction out of GIFT City.
Okay, great. Thank you very much. I think your views are very, very important. And from regulation point of view, you have covered very well all these aspects actually. So friends, now we have some questions from the audience. So if you are okay, then I can take some 2-3 questions, all panel speakers. Okay. So I have a question from Nidhi that apart from green energy sector, which sector do you think have potential to grow, where these inflows will give benefits? I think she want to try, she tried to say that other than green energy sector, which are the other sectors which are potential from the bond market point of view. So anybody would like to cover up on that?
Well, I will take it. So
Yeah.
there are multiple sectors which can benefit. So one is women empowerment. So a lot of focus across Asia and African countries are there where women entrepreneurship is being encouraged by various institutions, especially the Impact Fund. So if funding, a lot of fund is available towards which can go towards the women entrepreneurship, which institutions which are promoted by women. Second is WASH, which is water and sanitation. This segment is again a very green segment where a lot of work has not gone into. Market is very wide and people are willing to put it a lot of money around it. And third, as I said in my previous deliberation as well, that in India, many districts are identified as potential developmental district, which was backward, and where government of India is also willing to support, and a lot of domestic financial institutions as well as international financial institutions are willing to support. So that is the third area, which is also very large. So these three areas are pretty large after green energy.
Okay, great. Thank you very much, Kishorji, for giving the idea. Then we have another question this is related to the retail investor. So what should and any retail investor should look before investing in the bonds? So very good question. I think everybody would like to ask, even me and you also. So I think anybody would like to cover up, maybe all of you also. I think this is very, very important question. So Subramaniam sir, would you like to cover up on the retail investor, what the retail investor should look before investing in the bonds?
See, I would say that retail investor, first you take, what is the time horizon? Suppose whether you want to block the funds for 3 years, 5 years in the bond market, then accordingly, number one, you have to see the time horizon. Second one is that you see the credit rating of the company, whether it what risk you can take. Suppose the lower the rating, then higher the risk. So what risk, how much risk you can take, what is the duration which you are looking for, and sector also. Suppose if you have some decent amount to be parked, then you can diversify into various sectors, not putting in one sector also. So rating is the most important, because after this so many episodes, safety and liquidity is the most important rather than the return. So safety and liquidity, you see, safety you can see by way of your reputation of the company and the credit rating going by the past trends, and then what is your capacity in taking the risk capability, and what is your duration, whether it is 2 years, 3 years, 5 years, how long you can block the money. So based on this, you can, any retail investor can take a call.
Yeah, you're right, sir. Safety and liquidity. Liquidity still is a challenge, I think, for retail investor.
Yeah.
As you rightly
Yes.
suggested, for some exchange, some platform for the trading of the bonds, actually, which is still not there. So
Yeah. And more so, one
Yeah.
thing I just want to add it. Now, SEBI has given a draft discussion paper also on this bond market. They are planning to reduce the face value from 1 lakh to 1,000 rupees or 10,000 rupees. That the discussion paper they already floated. So once they reduce it to 1,000 to 10,000, probably this wide circulation of papers may be there in the market. Then the active trading may happen. So that is also one thing which is a positive thing which is going to come very shortly, because they already floated the discussion paper.
Right.
That
And
will
one
have
more, yes, one more thing is also there. We have protected our bond market, actually, where the larger entities can issue and all, basically. So like this SIP, there the lot of awareness programs are there, celebrities are there. Unless until we'll not create such kind of environment that the investment in bond market is good, actually, or right, or whatever the campaigning can be done. Till that time, it will be very difficult. The retail investors will come forward and will invest, actually. So I think this is also required, which can be done through the Investor Protection Fund, which Mr. Lodha has given the suggestion. And then SME exchange, SME bond market exchange can also be helpful, because a lot of, I think more than 1,000 SMEs are registered or listed in the stock exchanges now. So these SMEs which are listed in the stock exchange, they can be eligible for the raising bond, actually, for their funding requirement. So this can be another idea also. So I think there are many things which are there which can be done. Still we are way behind, but the good part is that we are now becoming global. The global indexes are now accepting us, which might bring a lot of money, and the yields also. But again, the question is that whether the yield will come down, then will it remain attractive for the investors? Whether this, so I think this is another question which we are discussing with the investors. When the yield will come down, whether this will be attractive to the investors or not, actually. So I think Ms. Fatma, would you like to cover up on that?
Sure. So what we are seeing is, of course, when we are saying yields will come down, it's not only because of these flows, because they are still just 3 to 4% of the market. The yields will come down with a lot of other things in terms of how our inflation is, how RBI looks at, cutting rates, what is the time, all that will also come into effect. Also, what we are seeing is that the bonds which are non-index eligible, okay, sometimes currently also there are certain arbitrage wherein, a similar tenor bond which is not included in the index might be quoting at a higher yield than the bond which is in the index. Why? Because there have been flows which have come into the index eligible bond. So there will always be those pockets where there will be an investment opportunity possible. Liquidity, as you rightly said, will be very important when investments are to be taken. But when we are talking about the GSEC market, I think so the liquidity is much better than the corporate bond market. So still those pocket of opportunities will be there. And it is very important that we deepen our bond market. And the liquidity is not restricted to only those on the run papers, and it expands to the other papers as well, which can happen in such a situation when only those specific bonds are seeing lower yields, but the others are. So it gives a clear arbitrage opportunity there.
Okay, great. So I think we have already overshoot our time limit. Actually, now we are at 5:15. So I would like to wind up the session here now, and I would like to thank you to all the panel speakers for joining with us in this today's webinar on such an important topic, which is on the bond market. And we have listened all of you, and I think your views are very, very important from our audience point of view. And we will compile these views actually, and we will send to you the all related ecosystem so that people get the benefit of it also. And I would like to thank you to the audience also for joining with us on various platforms, so on YouTube or on other social media platforms, and directly on the Zoom also. I hope that all of you will get some benefit of this discussion, and that might help you in your practice or whatever you are doing actually, maybe in the investment also. So I would like to thank you once again to all of you for joining with us and making it successful. Thank you very much, and I would like to thank you the Resurgent India team. Specifically our bond market team, Mr. Binay Gupta and Nidhi, and the digital marketing team, Mr. Devesh and Ayush and other team members. Thank you all for joining with us. Thank you, everybody. Thank you.
Thank you.
Thank you.
Thank you.
Thank you, everybody. Thanks a lot.